let's tell our listeners how to make money. Everybody's listening to this because they want to know, how do they retire? How do they get passive income?
What's special about triple net properties is that the tenant takes care of all of that. So when you think of mailbox money, for instance, that's a common term thrown out. These are one of the truest forms of that. It's the most hands-off investment you could probably look at in commercial real estate.
They're definitely recession-proof and COVID-proof. I didn't skip a single rent payment from Dollar General during COVID.
Hey everyone, and welcome to another episode of Commercial Connections, Investing with Confidence. I'm Rene, the producer of the show, and today we have an incredible guest joining us. Cody is a seasoned real estate investment expert and a partner at Trinity Real Estate Investment Services, specializing in acquisition and disposition of single-tenant net leased investments. With a BBA in business management from Albania Christian University, Cody has spent the last 7 years at Trinity, where he successfully managed hundreds of net lease transactions and consistently ranked as one of the firm's top performers. His expertise in the net leased market has helped him build lasting client relationships while navigating complex investment opportunities. Notably, his team has completed over 1,100 dollar store transactions in the last 7 years, making them a powerhouse in the industry. Beyond his career, Cody is a dedicated family man who loves spending time outdoors, whether it's hunting, traveling, or enjoying time with his loved ones. He brings the same passion to his personal life as he does his work one. Leading today's conversation is your host, Rene Nelson, an award-winning CCIM in the Eugene, Oregon area. Rene has spent years helping investors grow and refine their portfolios through strategic commercial real estate investments. Before we dive in, Cody, I just want to welcome you to the podcast.
Yeah, thank you for having me.
Okay, so let's dive in. Cody, let's tell our listeners how to make money. Everybody's listening to this because they want to know, how do they retire? How do they get passive income? And that is the part that I love about triple net and dollar stores. So let's start at the 30,000 foot level.
Yeah.
Tell the audience what a dollar store is and what type of an asset that is.
Yeah. So I guess what we specialize in is single-tenant net lease properties. And that's the bubble that dollar stores fit into. Dollar Generals have gone through different lease evolutions. Throughout the years, they've been building stores for a long time. But from about 2015 to current day, their lease structure has been absolute triple net, which means the taxes, insurance, and maintenance are fully on the tenant. As you look at the gamut of commercial real estate, there's going to be all sorts of different landlord responsibilities and lease structures where you might be responsible for paying the electric bill and the water bill and property management, snow plowing, like all of the things you can think of, those follow under the maintenance category. What's special about triple net properties is that the tenant takes care of all of that. So when you think of mailbox money, for instance, that's a common term thrown out. These are one of the truest forms of that, followed by like ground lease properties. High level ground lease properties would be where you essentially just own the ground and the tenant is responsible for the improvements. What's beneficial about triple net properties versus that are fee simple versus like a ground lease property. Fee simple triple net investment properties you can depreciate and take advantage of other avenues through. Whereas a ground lease, you essentially just own the ground, and there are other benefits with those. Dollar Generals, triple net investments, you own the improvements too.
This is great. So an example of a ground lease that I typically see is Taco Bell, where it's a fast food franchisee that wants to go in and build a store, right? Is that what you see with ground leases often?
Yeah. So that's exactly right. You would own the ground. The tenant would be responsible for building the property. Very similar, like take care of the taxes, insurance, maintenance. They are fully responsible for all of the improvements. So very similar in some ways, different in others. But back to your question, absolute net is another term thrown out for net lease properties. Absolute net would be the triple net Dollar General stores, for instance. It's the most hands-off investment you could probably look at in commercial real estate. If you're a new investor that's looking for a retirement property and you live in California and you want to own a property in Texas, I would look for an absolute triple net property to invest in, just so you don't have any responsibilities or anything to take care of.
And typical price point, just for the audience, ranges based off the term of the lease, right?
Very much so. It all kind of goes back to the rent they're paying. And then also lease term, it's a combination of several factors. But yeah, the value of net lease properties is heavily weighed on lease term remaining. The longer the lease term, generally the lower the cap rate. The shorter the lease term, the higher the cap rate.
Yeah, and I just wanted to add to that. The reason for the higher cap rate is directly correlated to risk. So the risk there is if there's 5 years, 7 years left on that lease, the tenant may or may not renew. So that's part of the risk. I would love to have you talk about Dollar General's leases, because I've heard that they've changed. They always were kind of a brand new lease was a 15-year, I always called it a 15-year fresh cut lease, restated. They just signed it. They're in their first year. They've got 15 years. It's corporately guaranteed. But there weren't many rent increases that were built into that, but that's changed. So can you talk a little bit about that?
Yeah, for sure. Backing up a little bit. So Dollar General they have 20,000 locations. They really started building stores in the late 90s. Those were double net leases and generally like 10 to 15 years. They stayed a double net structure in that age range until about 2015. They had different landlord responsibilities fluctuate through those years. But then 2015 to call it 2023, they were 15-year flat leases. So they would be flat for the initial term of 15 years. And then they would generally have like 4 or 5-year options to extend the lease. And each one of those options, they would have a 10% rental increase. So those would be options for the tenant to stay in those locations. From the new lease structure that just came out, started, I would say, in late 2023. They are now doing 5% rental increases every 5 years of the primary term. And then the options are 5% increases. So it'd be 5% every 5 years of the initial term, and then each option would be a 5% increase.
And why did Dollar General decide to change their leases to that structure?
I think it was just to be more competitive in the market for their developers. That was a big hurdle for a lot of investors and institutions. As you look at the gamut of different tenants and sectors, a lot of tenants have rental increases built into their leases. Everyone likes to talk about inflation now, everything else. Being able to keep up with inflation is a huge thing to a lot of investors, or have some sort of upside. So I think just from a desirability of their product, I think that was one of the drivers. And then helping their developers move product is kind of where my mind goes. If they can help their developers have a more desirable lease, it helps them move product and build more stores for them. So, on that, Dollar General has 20,000 locations now. Over the last at least 5 years, they've tried to build 800 to 1,000 stores per year. And they do that through their preferred developers. They're churning and burning, trying to grow as much as possible. And their developer relationships are a huge piece of that. So.
And how many developers are there overall? A couple of hundred? Because I know it seems like one developer, like in Texas, as an example, may build all the stores in that area. It sounds like once that developer builds a relationship, then they just go out. And I'm also curious, does Dollar General find the site and then go to the developer, or does the developer find the site and then go to DG and say, hey, we got a site?
Yeah, that's a good question. And I'll speak to it as much as I know, because I obviously am not on the development side. And I just have knowledge from my relationships. But from my understanding, Dollar General will tell these developers general areas they want to be in, and then it's the developer's responsibility to go out, find the land, and then work with Dollar General to see if it makes sense to have a store built there.
Okay, so part of my goal is to educate people in these podcasts, and Brittany is kind of my test case. Yeah. So what I always like to do is check in with Brittany and ask her questions, because I think it's relevant to our audience.
Absolutely.
So before I do that, Brittany, one thing I'd like to do is, hey, Cody, walk us through when a developer breaks ground, from that time until you call a real estate broker like me and say, hey, I've got a Dollar General in Texas that's coming to the market in a couple of weeks. Explain to the audience how that developer goes through like the punch list, and then Dollar General executes the lease. They put their racks in, kind of walk everybody through that process.
For sure. So generally, every deal is a little different, but generally the developer will purchase the land. And then once he has closed on the land, he'll begin construction. From the moment he breaks ground, it's usually, depending on the municipality and just weather and everything else, it's usually about a 90 to 120 day turnaround on breaking ground to building completion. Depending on the developer, some of our developers share details on, the store, when it's going to open, the rent. All of those items are signed into a lease and able to share with brokers like us. Usually once the ground has been purchased and he's started construction, right? Those are firm details. So a lot of our developers will share details once they began construction. And then at that point, we know generally when rent will start and the store will open. So that's when, you might call me as another broker and say, hey, Cody, I've got a buyer. He wants a Dollar General in Texas between this price range. And we can look at our pipeline and say, okay, you have an exchange client. We need to close in the next 6 months for your exchange window. This store is going to open in 4 months. Here's the details of the store. That's generally when we start sharing details. Does that make sense? And then as far as the construction process goes, so they break ground, they pour the slab. It's about 120 days. Near the end of that, say we go under contract somewhere in the beginning of that process, near the end of that process, say the shell is completed, Dollar General is ready to fixture the store. So that's one of the last pieces of the puzzle. Once the shell's completed, electrical's done, utilities are connected, the parking lot's finished, stripes are put down, like the building is pretty much done and ready to operate business. That's when the developer turns it over to Dollar General and says, okay, my job is done. You can go in and fixture, which means they'll go, to my understanding, like take all of this for what it's worth. I'm just a broker. But from what I've seen, they call it fixturing. Dollar General will go in, put in their kiosks, stock the shelves, do all the things. That usually takes about a week. And then after that, they'll open the store. And then usually after they open the store, it takes about a week to clean up what's called punch list items. And if you've ever been around construction, whether it's your house or whatever, it's usually called the same thing. So there's usually a laundry list of little things that need to be cleaned up for Dollar General to put a stamp of approval on the project saying, okay, everything's perfect. We accept the building. Good job, Mr. Developer. So that punch list item process usually takes about a week. And then after that, we're able to order what's called an estoppel. So back to your question about putting these deals under contract, we usually tie closing on these deals that are under construction to receipt of what we call a clean tenant estoppel. So an estoppel is simply just a letter from any tenant that says we're open, we're operating, we're paying rent, and landlord is not in default for any reason. We usually tie all of our contracts to receipt of that because it's a really good golden ticket or insurance policy for the buyer from a transaction standpoint of if I don't receive this, once I do receive this estoppel, it means I'm receiving a perfect product. From a contract timeline standpoint, we tie a lot of things to that. Because if we have a clean estoppel, it means the punch list is clean. We have a clean CO. All the permits are finished. The store's open, operating, paying rent, and the developer is not in default for any reason. It protects buyers. The developer cleans up the punch list items. We order estoppel. It usually takes about 30 days to come back. Once that's in hand, we can tee up closing and the buyer can walk away with a brand new Dollar General store and start collecting rent. So I'm trying to think if there's anything left out.
Yeah. That makes sense to me. I have some questions. So that's where you both are mainly involved. The tenant is the one that's paying rent. So they own the Dollar General. They're leasing it from the buyer. How do they get involved? Where do they come in the process?
As far as Dollar General,
Mm-hmm.
it's almost as simple as like a rental house. So they are the tenant, you are the landlord. They are strictly just renting the property from you and operating their business. So
Okay, they're just like the business
yeah,
operator. Do they get like any percentage of the business, or they just get like a salary, or is that building to building? What's the tenant get out of it?
So let me jump in. I think I can help.
Yeah.
They get a brand new location. So it's called a build to suit. So Dollar General may say to the developer, hey, we want to be on the corner of Main and Main in Texas. So that developer will go out and find that location that's available and then go back to Dollar General and say, we found your location. We'll build the building. We'll have it ready, like Cody said, in 120 days. And then Dollar General moves in. They take possession of the building as far as they're the tenant. They move in all their racks and all their merchandise, but they're just a tenant. Dollar General's not in the business of owning the real estate. So that's where it becomes a great asset for a passive investor who wants to own real estate. They don't want their money in the stock market. They want it in something tangible.
yeah,
And so Cody represents the developers who have built those stores. Dollar General's moved in. It's an operational store. So then Cody he's the Dollar General broker. So he just, when I call him, I'm like, hey, this is how much money my 1031 buyer has. And Cody looks down, well, he sends me a list. There's about what, Cody, 30, 40 different properties at any given time in your pipeline?
yeah. We generally have 80 on market listed, and then we also have some off market that are coming up, just depending on the state and the criteria. So.
Oh, wow. So it's more just like the deal making part of it. Like you're looking for ways that it's just investment strategies at that point, like mainly and when you said exchanges before, it's mainly 1031 exchanges.
Yeah, it's a mix. Yeah. I think of our transactions, we track it every year, and 70% lately have been exchange buyers. And that's largely been because of where the debt markets are. I think back in 2021, when debt was really aggressive and cheaper, it was at least 50% exchange buyers, but there's more people utilizing debt and just buying it outright.
Yeah.
So I have a question for you, Cody. Dollar General is kind of known as a strong tenant base because it's a corporate guaranteed lease. Dollar General is traded on Wall Street, so you can look up the billions of dollars that they're worth and stuff. From your standpoint, what makes Dollar General and even dollar stores, so we should talk about, Dollar Tree and Family Dollar, what makes that type of a tenant a reliable tenant triple net source for a passive investor?
For sure. I would say when you're looking at leases, you're buying a source of cash flow, and those leases are only as good as who's signing them. When you're buying a Dollar General, it's signed by Dollar General Corporate. It's not signed by a franchisee. It's not signed by a mom and pop. You're getting a large corporation that in our industry, it's called investment grade credit. It's a very strong backing, and even worst case scenario, I've never seen it happen, but say a store goes dark, say a store closes and there's 5 years left on the lease, Dollar General Corporate is the one that is going to honor that lease and continue to pay rent versus like say you owned a thrift store that was owned by a mom and pop operator and they signed a 10-year lease and they decided to shut the doors when there's 9 years left. You're probably just out of luck. You're not going to collect any of that rent that you were planning on. So you're really buying confidence. And back to what you're talking about, cap rates and risk. You can find plenty of other deals at higher cap rates, but you're also buying risk. And, unfortunately, bad things do happen in these deals. And I feel like if you were putting a client or family or friends in these deals, it just helps you sleep at night knowing that you have a large corporation that is easy to deal with, that is guaranteeing your income, if that makes sense.
Do you have investors that own Dollar Generals? I'm thinking to myself, actually, I have a couple of Dollar Generals that I own in my own portfolio. And I'm sitting here thinking, hey, I have the old lease where it's set for 15 years. I don't get rent bumps at the end of 5 years. Do you have active investors who are coming to you and trading up and trying to buy new properties with the better rent incentives?
Yeah, I would say there's less clients coming up to us to like upgrade their Dollar Generals from like if it was a triple net Dollar General with a flat initial term to like upgrade into a new lease structure. There's fewer of those, but what we see a lot is investors that might own 3 or 4 older double net Dollar Generals where they're responsible for the roof and the structure and the parking lot and the HVAC, and they're getting older and they want less landlord responsibilities. We do see quite a few of those that approach us that want to sell those properties in exchange into a new store that's absolute triple net that, you know, they can not have any responsibilities and retire or
Like
whatever.
hands off.
Yeah, exactly.
Yeah.
So sometimes at the end of the podcast, I give Brittany a pop quiz. So Brittany, here's your little hint. Double net is where typically the tenant, in this situation, Dollar General, and the older stores like Cody's talking about, double net is where they're responsible typically for taxes and insurance. And then the older properties, like Cody just said, the landlord or the owner of that building may be responsible for parking lot maintenance, HVAC, roof, things like that. The new ones, Dollar General is responsible for everything. I've said in prior podcasts, they don't even want the owner on the property picking up a popsicle wrapper. Yep. They do not, because they don't want owners coming and saying, oh, you're not running the store right. They've got whole crews that do everything from parking lot maintenance, snow removal, and they don't want, 2,000 owners trying to tell them how to run their operations.
Right.
Yeah. I could see how that's really attractive for investors.
It is. And the benefit is, like a couple that I own, they're out of my state of where I live. So it's clear across the country for me. And it would take me all day to fly there to look at it. I do it every now and then. But yeah, it's great for passive investors. And I've had investors say, oh, well, I'm going to buy in a city where my child lives, my adult kid lives. Yeah. And I always say, don't do that. Don't do that, because you're going to hamstring yourself and try to buy in a specific area, and it may not have a great cap rate or it may not have good cash flow. I always tell them, let that property generate the cash flow and use that money to go see your kids. That's what people are looking for, is the cash flow to live on. Yeah. So, Cody, what's your thoughts on that, about trying to pick a certain city to buy a Dollar General in?
Yeah, no, that's a really good question. There's so many factors that go into it, and just investor goals. I look at several different things when I start looking at DGs. Always boils down to the investor goals, but yeah, you have a spectrum, right? So like you have a spectrum of the highest yield possible, and usually those equate to Dollar Generals in the smallest, littlest towns in the middle of nowhere at higher caps. And then you also have Dollar Generals in what we call income tax free states like Texas. A premium Dollar General would be a Dollar General in Austin, Texas, on Main and Main, that is going to be on the lower end of cap rates. So you're going to pay a premium, but it's in really, really good real estate. So it's a spectrum. And at least on new stores, if you're looking at a new development pipeline, the first place that I start with is the population density. So like a lot of times us brokers look at the 1, 3, and 5 mile population and just whittle it down from there. But kind of the silver bullet in my mind is maybe not that store in Austin, Texas on Main and Main, because it's a really premium product with a premium cap rate. And maybe it's not the Dollar General in the middle of nowhere that's, at a really high cap rate, a really great return, but it's also in the middle of a cornfield. There's a blend there. And that's where experts like Rene help investors digest the information and say, okay, you don't want to pay a premium. You don't want a store in the middle of nowhere. Like, let's look at these that are in the middle that make sense, because Dollar General's bread and butter business, they are a convenience store. They want the clientele that can't necessarily get Amazon Prime or run into Target or run into Walmart and just grab inventory. Some of the best stores that perform in the country are in towns of 20,000 people. And this is the only place to buy toilet paper and bread and milk. And the entire town knows that, and the store does 3 times what the store in Austin, Texas does. You really need a wise broker that knows what they're looking at to help digest the information, because there are 20,000 locations and it's one of the most marketed properties on, say, Crexy. You go on Crexy and there's 600 options. You really have to know what you're looking at to pick out. Misconception that a lot of investors have is, oh, there's 700 of them. They're all the same. I want to throw a dart at a board and it won't make a difference. Whereas it really does to me. And maybe I'm wrong. Maybe I'm biased.
I'd like to add to that. I think you're spot on, Cody, because not everybody is going to pay all cash. Let's say a Dollar General is 1.5 million, 1.9 million. They're probably going to use some amount of leverage and get a loan. And I know that the lenders are concerned also about the population in that 1, 3, and 5 mile radius. If I remember right, to get the most favorable interest rates within a 5 mile radius, they like about at least 15,000. They call them rooftops. They like about 15,000 people living at a minimum within a 5 mile radius. Does that sound right, Cody?
That's probably right.
Or close.
It varies so much lender to lender, but I think that's a really good rule of thumb. I feel like the stores that I can think of that have at least 15,000 people in the 5 mile, my mind always goes to the worst case scenario, but if something terrible were to happen, Dollar General goes bankrupt and you have to find a tenant for that building. I feel like if there's at least 15,000 people in the 5 mile, you can probably find a similar national credit tenant that would want that space or something similar. Once you start dipping below that threshold, these towns get really small. And it's not the worst thing in the world. Like, those stores are attractive to the right investor. It's just, if you're trying to find kind of the best of both worlds and have your cake and eat it too, like, that's a good blend in my mind. At least 15,000 in the 5 mile, maybe up to, call it 50,000 people as a rule of thumb. It varies so much deal to deal. It's hard to give you an absolute. But yeah, and lender to lender, like, I've seen so many lenders have their own little rules and differences. But yeah, that's a good rule to go by.
What are you seeing for cap rates overall, general cap rates for a Dollar General? Where are they falling right now?
So I'll say on the most aggressive side for new development inventory, you're probably around a 6.5 cap. It's pretty realistic. And then on the upper end, on the really small towns in states that aren't Texas or Florida or Tennessee, you're probably in the 7 to maybe 7.25 range if you're really lucky. What's setting the ceiling on cap rates, just so everybody knows, there's large institutions of the world like REITs that buy portfolios of Dollar Generals, and there's several out there that tell developers, like, hey, we'll buy tranches of these stores at 7.3 cap or 7.4 cap or 7.25. They're setting the ceiling for this market. And that varies monthly by who's the player, who can get the most aggressive. It's hard to give you an exact number because it changes so much. But just from a private buyer standpoint, you can't go out and buy a new development Dollar General at a 7.5 cap because there's 12 other institutions that will buy 40 of them today at that cap rate. So 6.5 to 7.25, and that's why.
Well, that probably helps your developer too, because then your developer knows, okay, worst case, I could sell at a high cap rate, which means he's going to put less in his pocket for a sales price, but he could sell at a 7.4 cap. But at that point, he just turns to you and says, here's 13 stores, go sell them. And then you're trying to get the best price for your developer, right? And then if he doesn't, as he sells them down, he may just say, okay, we're going to cut off these 5 and sell them to this REIT, or the REIT exercises that option and says, hey, we want these 5 because we just got a big chunk of money and we need to place the money and stuff like that. Is that how it works?
At a high level, and it doesn't always work where they can even sell those stores at prices that REITs will pay just based on where they built them to or how much money they have in those deals. So it doesn't always work, but that's generally setting the ceiling on the market for dollar stores as the institutions. So.
Okay, that's good to know. And do you see that most of the REITs will buy the stuff that's a population of 300 people within a 1 mile radius. So
Yes.
it's the REITs that are buying those.
For the most part, there's a few REITs out there that are very sensitive to the population density, but REITs on the spectrum of cap rates, again, REITs want the highest yield possible to tell their investors, hey, we just bought $100 million in Dollar Generals at a 7.25 cap. This is going to be a return. Rarely is population density a factor there. It's more just cold hard numbers.
Yeah, that makes sense. Okay, Brittany, what questions do you have at this point?
So my question is, okay, maybe a quick synopsis of REITs. Is that REIT?
Real estate investment trust. Yep.
Okay, and that is sold at fractional pieces to like individuals.
Yes. Yeah. They're publicly traded companies that you can go and buy a stock of.
And then like BlackRock and people like those institutions, do they own a lot of DGs too?
I don't know if BlackRock owns any.
They're more residential.
I would say so. And I could be totally wrong. Like,
Yeah.
take this for what it's worth. But Realty Income is a huge owner of Dollar Generals. Spirit Realty was acquired by Realty Income, but they were a large owner, hundreds, if not thousands of stores.
Okay.
There's a lot of institutional money that every year buys 10 to 20% of the new inventory that is produced. So
Is coming out. And does GG have like, would you say you feel confident in their plan to keep developing and their growth strategy? Because they are growing pretty rapidly and have been for decades, right?
Yes. So they've built 20,000 locations. I pulled up some quick numbers. So last year, they opened about 800 stores. This year, they're opening 575 stores. And I think that's just a combination of, also take this for what it's worth, just my assumptions. I think it's a combination of construction costs rising, rents rising along with construction costs. At the same time that they announced they'd be opening 575 stores, they said they were going to remodel 4,200 stores, whereas last year they did about 2,300 remodels. So what that tells me is they're pulling back a little bit from the new development side, and they're investing more money in remodeling the existing stores they have. It makes me feel good about definitely the clients' stores that we've sold them. And like to your point, the stores you own, there's a good chance they're going to stay in those. Because that's one of the number one question and statement we hear all the time is, well, why would I buy a Dollar General? You know, they could pick up and move down the street and open a new store and I'll be stuck with the empty building. It's like, yeah, that's a major concern, right? This is all public information. You can Google it. Dollar General puts it out there. But I think on average, Dollar General closes or relocates about 200 stores per year. Most of those stores, from what I've gathered, are either stores that were in strip centers or they are in smaller footprints that Dollar General doesn't build anymore. So they can't fit as many products in those stores as they can in these new footprints. So like Dollar General right now, they're building 9,100 square foot stores, 10,640, and then 12,000 square foot stores. And if I were an owner like Rene that has, just say you have 4 stores, and they're all 9,100 square foot stores, I would feel really confident that they're probably going to stay in those stores. No new stores necessarily report store sales. It's hard to know store performance. The average store does about 1.5 million in sales from what I've gathered. So like if you're able to talk with your store manager and they tell you, oh yeah, we're doing 150,000 a month, or we're the best store in the county, or most of these store managers are pretty forthcoming. As long as you have good information that it's a decent store, they're not, oh yeah, we're doing 800,000 last year. Like, as long as there's no red flags like that, there's a really good chance they're going to extend that lease and you're going to be fine. Just my 2 cents.
And I'm curious, in that 12,000 footprint that they're building, are they adding more like fresh produce and grocery consumables, milk, stuff like that?
So they call those the Dollar General market. They made a really big push on the market stores, call it 2-3 years ago. And as construction costs have, so they put more freezers, fresh produce section. and then just more SKUs, so like more part numbers. What's happened is with construction prices going up and rents going up with them, they're actually pulling back from the 12,000 square foot stores, and they're building more 10,640s and calling those DG markets. Some people call them mini markets, but they're Dollar General markets, where they have the expanded freezer section and then also the fresh produce. So from our pipeline, like we have a lot of developers we work with. Looking at their pipeline, there's hardly any 12,000 square foot stores coming up. They're all 10640s or 9100s. I'd say they're probably 60% to 10640s. And I think that's just to save money on rent and construction costs.
So Dollar General and triple net properties, Dollar Store, Dollar Tree, those are often like a long-term play for investors.
Yeah.
At what point do you see a strategy? Let's say they've got a 15-year lease when they initially buy the asset. What kind of strategy do you see investors use on those where they maybe try to sell them and buy a new store so they get a new lease? What's kind of that tipping point?
So there are several different tipping points, and you kind of have to make some assumptions that the market stays the same. So there's, let's call it, two different buyer profiles. So there's the buyer that buys, and they're going to keep it till the wheels fall off. They're going to hold it, and if something were to happen, they're going to put someone else in it. They don't care. That buyer's great. We're not worried about them. The other buyer that we deal with a lot is the buyer that will hold it and then sell it in 5 years. So you talk about tipping points. So like a Dollar General lease term, it's 15 years of initial term. The tipping points that I see in value are about every 5 years. So if someone were to buy a 15-year brand new out of the wrapper Dollar General and the market stays the same, you can buy that store with 15 years on the lease, hold it for 3 or 4 years, and sell it for close to what you bought it for, given everything stays the same. We have buyers that do that, and they exchange every 3 or 4 years just to hedge against any sort of value loss, because as lease term burns off, so does your value, which is kind of hard for some investors to get their mind around. So that's usually the first tipping point. It's hard to say. So like that's at year 11 or 12. At year 10 you might lose 25 to 50 basis points, let's call it. So if you bought a store at a 6.5 cap, with 10 years left on the lease, 7 cap, let's just say for fun. And then when there's 5 years left on the lease, another 5 years go by, that's at least another 50, if not 100 basis points, just theoretically if the market stayed the same. So that 5-year triple net DG, you're probably closer to 7.5, if not 8 cap. So backing up, if you bought a new store, your value loss would be when there's 10 years left, when there's 5 years left. Those are the big tipping points. And usually people choose to sell at those points or slightly before is kind of the theme that I've seen. Because once you get past the 5-year mark, like once you're in that lower lease term range, rarely does Dollar General extend more than 5 years. Like you might see it a few times, but the landlord's probably giving up rent or free rent or lowering the rent to get them to extend multiple options to have, say, a 10-year term. It's pretty rare. And usually Dollar General, especially lately, won't extend leases unless you're within 6 months of the lease expiring, maybe shorter than that. So it's not like people can buy these deals, let 5 years burn off, and then at year 10 exercise a 5-year option early. Like that doesn't happen. It's not in Dollar General's best interest unless you want to slash rent and just give away money. So
I do have investors ask me that all the time, especially when they're looking at different spreadsheets of available Dollar Generals, and they'll see something with like 5 or 7 years left. They're like, well, let's just go to Dollar General and, renew the lease now. And it's like, no, that's not how the big guys play. They wait because they're waiting for market trends and to see what's going to happen. So they're going to wait till the very last minute to decide on that lease.
Yeah.
Okay, so Brittany, I'm going to give you just kind of a reference. So let's say I have a 1031 buyer and I call Cody and I say, hey, they've got 1.5 million to place. They're doing a 1031 exchange and they want to buy a store and they'll just buy it outright. We're not going to use any debt, any leverage. So Cody, just off the top of your head, 1.5 million is probably going to get us what, like a 6.5% cap rate, roughly?
From like a cap rate perspective, the
Yeah.
hard part is, so rents have gone up. So it would be very difficult to find anything with, say, longer than 12 years of term at 1.5 million. So you would probably be looking at a store with, say, 12 years remaining. And a lot of those you could probably get at least 6.75, if not 7, because the term has burnt off a little bit. But yeah, the new stores that are coming out, rents are probably, let's call it on average, 140 across the country. And this is just me speculating. So let's call it 140 at a 6.5 cap.
So that's 140,000 at a 6 cap. So that'd be 2,333,000. Call it
Correct.
2.3 million.
Yeah, so you'd be
right?
outside of your price range. So you'd have to look at something with shorter term and lower rent to fit your price range.
Okay, so Brittany, here's your stacking order.
Yeah.
2.3 million is the top, where you're getting a brand new, fresh 15-year cut lease. You're getting good cash flow, about 140,000. Then if you go down like a 1.5 million, now you're getting 12 years left on the lease. Okay. You can get all the way down. I've seen Cody spreadsheets where they're like 5 years are left on the lease, 7 years are left on the lease, but you're going to be at a lower price point at like, I've seen some on Cody's sheet at what, 800, 900,000, depending on the term left on the lease. But the risk is you're only guaranteed that cash flow for 5 years. And then at the end of 5 years, you're going to have to renegotiate with Dollar General on the lease. And I had an investor that did a pretty substantial 1031 exchange, and he bought some like that with high cap rates. He knew the risk. He's done really well, but he also went through some pretty tough negotiations on some of his other properties with national tenants, not so much with Dollar General. So if you've got the stomach for it, it works for some people, but not all investors. Like, I don't really like to grind out lease negotiations like that because I don't want to lose. You know, I don't want Dollar General to say, well, sorry, we've changed our mind, or we can't accept your terms, so we're going to move down the street. So I kind of like that predictability.
Absolutely.
Yeah.
Okay, Cody, what's one thing that you would like our listeners to know about Dollar Generals, whether it's Dollar Trees, Dollar Store, Dollar General? Because I think these are like awesome investments for people that are looking to create passive cash flow.
Absolutely. I just think, and I'm biased, but I think that if you look at the whole market, and if you look at the price range between $1 million and $2 million, which is very common for a lot of these investors, if you're looking at the product you can buy in that range, and you look at the credit of the tenant, the lease structure, the lease term, the cap rate, the locations, all of that, I feel like Dollar General is the highest cap, best credit, best lease structure that you can purchase. And if you were my sister or aunt that were looking for a store today, I would put you in one of these stores and sleep fine at night, knowing that your income is protected. And of the options out on the market today, this was probably your best choice from a tenant perspective. And when the time came to negotiate rent or anything like that, I think Dollar General is one of the easier, if not easiest, companies to deal with. I've been in Rene's shoes where you tell your client a property and they get drugged through the coals negotiating a lease extension, and it changes their lifestyle, and you bear that responsibility. And it's hard to stomach, but I haven't had experiences like that with Dollar General. And I feel like of all of those factors, no company is perfect, no deal is perfect, anything crazy can happen. But Dollar General is an excellent choice for investors looking for a safe company to put their money in. So.
They're definitely recession proof and COVID proof. I didn't skip a single rent payment from Dollar General during COVID. It was actually better, you know, because a lot of people needed to go into a grocery store, and with social distancing and everything else, Dollar General really fit that need to just go in and get diapers and go home or whatever you needed for quick supplies. So
Absolutely.
I definitely see how they could be recession proof. And because I came from a really small town, and that was one of the only stores that we had in town and where we got most of our supplies. And like, it just makes so much sense. Like you were saying, you sleep really well at night, knowing that if someone you loved owned one of these stores, their money is protected. And yeah, I think it is like a safe bet. Definitely.
Yeah, for sure.
All right, Brittany, what questions do you have? You've got the master Cody here. You can ask him anything about Dollar Generals or triple net.
Oh man. Yeah. The evolution of Dollar General, I thought that was really cool. Talking about like the different leases that we saw from the beginning. And then now we're seeing the triple net leases in our current state. And
the rent bumps. That's the key.
Oh, that's interesting. Yeah. Where do you see that going for like people in the future? Like, do you think that makes it an even better deal because they're doing the rent bumps now?
I think it definitely helps the investor. I think it helps the landlord. I don't think those stores necessarily, they demand like a premium. I think that's more setting the stage to be the standard. And back to Renee's point, I think the more and more of those that are exposed to the market, it might impact the value of the flat leases going forward. But at the same time, the lease term of those flat stores is going to burn down to that 5-year period where they're never going to get past 5 years again. And they are going to get those lease bumps when they do extend. So I think it's only going to help. And those flat leases are eventually going to get to that point where they're short term anyways. I don't think it's going to necessarily hurt those investors. If anything, those investors that own older stores have larger rental bumps built into their leases that are 10% versus 5%. So it kind of helps them in a way. But no, I think I really like the trajectory they're going with lease bumps. There's other things that I think that Dollar General can do to their lease structures that might help just from a landlord perspective. Like we've talked about property taxes. I think if they could ever get to where they could, pay property taxes direct, that would save a lot of heartburn. That's the only caveat of Dollar General investors to know is they pay property taxes and are reimbursed within 30 or so days. But that's the only landlord responsibility. So
yeah, that seems pretty easy. I would take that.
Well, Cody, thanks for being here today. And thanks for sharing your knowledge with the audience and the listeners. I know they have got a lot of good information out of that. Thank you.
Oh, absolutely. I loved it. If I can never do anything to help, let me know.
Yay. It was so great talking to you, Cody. Thank you. Next time on Commercial Connections.
Both Darcy and I can attest, we've watched people get in over their heads, lose that opportunity, have to give it back to the lender or the bank because they had substantial cost overruns. So do you guys normally have them put together like a budget so they have a pretty good idea of what they're going to do on the property and how they're going to come out whole?
Oh, completely. The loan team treats it just like it was a construction loan. They do everything. They have to have the budget of what they're going to spend on each item, and they do construction draws just like they do on a construction loan. So it's very similar. They have to have proof that the work has been done so they can go to the next stage.